Welcome to the deep dive. If you're looking to grow your wealth, especially in the vibrant Indian market, today we're zoning in on a really key decision.
That's right. It's navigating those investment options.
Exactly.
We've been looking closely at the Indian Investor Guide by Genspark, the one from last November. And, well, our mission today is pretty simple. We want to pull out the essential stuff you need to know, understand the real differences, the pros, the cons, between index funds and picking individual stocks, specifically for India.
Right. The goal is to help you make informed choices, but, without getting totally bogged down in jargon.
Precisely. Empowering choices.
Okay, let's jump right in then. For someone trying to build wealth in India today, what's the best path? Or maybe combination, index funds, individual stocks. How do you even start thinking about that?
Well, yeah, before we get to which path, we need the basics. What does investing in India even mean, fundamentally?
Good point.
At its heart, investing is just strategically putting your money to work.
Yeah.
Allocating resources, expecting them to grow over time. Now, the Indian market, it's a really diverse landscape. And understanding that risk-return trade-off is absolutely critical here.
A classic trade-off.
Exactly. Generally, if you want the potential for higher returns, you often have to accept, well, more risk.
And the Indian market can swing quite a bit, can it?
It certainly can. Volatility is definitely a factor, so making informed decisions, knowing what you're getting into, that's just paramount for your financial future.
So, given that risk, how can investors in India manage it? What are the strategies?
A really foundational strategy is diversification. It sounds simple, but it's powerful.
Don't put all your eggs in one basket.
Pretty much. It's about spreading your capital across different types of assets. Maybe some equities, some bonds, maybe even real estate.
Right.
That way, if one area takes a hit, hopefully the others cushion the blow. This is super relevant in India, where, different sectors can move quite differently based on economic shifts.
Makes sense. And what are the typical vehicles people use to invest here? What does the guide mention?
The guide highlights the common ones. You've got stocks, obviously owning a piece of a company. Bonds, basically lending money to governments or companies. Mutual funds, which pool money from lots of people.
Right. For diversification.
Exactly. And then index funds, which we're going to really dig into today. Each has its own feel, its own benefits, its own risks.
Okay, perfect segue. Let's dig into index funds. What exactly are they? How are they put together?
Right. So think of index funds as these pooled investment vehicles. They can be mutual funds or, increasingly popular in India, ETFs, exchange-traded funds.
Ah, yes, ETFs. Heard a lot about those.
Yeah, they trade like stocks, often have lower costs. But the key thing, whether it's a mutual fund or an ETF, is that an index fund is designed to just mirror a specific market index.
Mirror it, so not trying to beat the market.
Exactly. Instead of having a manager picking stocks they think will win, the fund just holds the same stocks as the index it tracks, and in the same proportions. It's a passive approach.
Okay, passive investing. What's the thinking behind that strategy? Why not try to beat the market?
Well, the philosophy is based on a long-term view. The observation that over the long haul, the market as a whole tends to go up.
Right.
So by just replicating the market's performance, the aim is to get decent returns without paying the often higher fees that come with active management, trying to constantly pick the best stocks.
And that often leads to a buy and hold approach.
It does, yeah. Which has other benefits like minimizing how often you trade, which cuts down on costs and potentially reduces your capital gains tax bill.
Makes sense. Now, for the Indian market specifically, what indices are we talking about? Which ones should people know?
The two big ones, the main benchmarks really, are the Nifty 50.
Okay.
That tracks the top 50 companies on the National Stock Exchange, the NSE. And the other is the BSE Senses.
The Sensex, right. Heard of that one too.
That one tracks the 30 largest, most actively traded stocks on the Bombay Stock Exchange, the BSE.
So these indices are like a snapshot, a health check for the market.
That's a great way to put it, a pulse check on the Indian equity market. So if you buy a Nifty 50 index fund, you're essentially holding a slice of those 50 leading companies.
Right. And if the Nifty 50 is up, it generally means the big players in the economy are doing well.
Generally, yes. It signals positive sentiment, growth across major sectors.
Okay. And you mentioned costs earlier. What makes index funds cheaper?
This is a key advantage. It's their structure. Because they're passive, they don't need big teams of analysts researching companies, deciding what to buy or sell.
Less overhead.
Exactly. So their management fees or expense ratios are typically much, much lower than actively managed funds.
And that difference adds up over time, I imagine.
Hugely. Even a small percentage difference in fees can eat away a significant chunk of your returns over, say, 10, 20, 30 years. It can be a really substantial amount, especially with typical Indian market growth.
Wow. And lower taxes too, you said.
Generally, yes. Because they buy and hold more, there's less trading activity inside the fund. Fewer transactions often mean fewer taxable events for you, the investor. Lower capital gains taxes.
Okay, that paints a really clear picture of index funds.
Yeah.
Let's switch gears now to the other side, individual stocks. What's involved there?
Right. So investing in individual stocks means you're buying shares directly in a specific company. You become a part owner.
A shareholder.
Exactly. And as a shareholder, you have a claim on that company's assets and its earnings.
And the potential payoff comes in two main ways.
Typically, yes.
Sure.
One is capital appreciation, the stock price goes up. The other is dividend income. That's if the company decides to share some of its profits directly with shareholders.
Okay. And what kind of approach does this require from the investor? It sounds quite different from passive index funds.
Oh, completely different. This is active management through and through. It requires a serious commitment. You need to do your homework research, dig into financial statements, really understand the company's business model, its competitive position.
And keep up with the news.
Constantly. You need to stay on top of market trends in that specific sector. Is it tech? Pharma? Consumer goods?
Yeah.
All big in India? You need to watch for any news, any event that could hit the stock price. It's very hands-on.
Sounds time-consuming.
It definitely can be. And, it's not just the company financials. The guide points out you also need to grasp things like the Indian regulatory environment for that sector, the competitive pressures.
Domestic and international competitors.
Right, especially in areas like, say, renewable energy now. It adds layers to the analysis needed for individual stock picking.
Can you give us some examples? What are some well-known Indian stocks the guide mentions?
Sure. The guide highlights a few big names, like Reliance Industries.
Yeah.
The huge conglomerate involved in everything from energy to retail to telecom.
Right, massive company.
Then you have Tata Consultancy Services, TCS, and Infosys, both giants in the IT services space, globally competitive.
Why are these noteworthy for investors?
Well, they're often cited because they have strong market positions, generally solid financials, and perceived potential for growth. Reliance's diversification is a factor. TCS and Infosys, their consistent performance and innovation in IT.
Okay, but we talked about risk. Individual stocks sound like they could bring higher returns, but what about the flip side, the risks?
Yeah, that's the crucial trade-off again, volatility. Investing in single stocks inherently carries more risk of price swings.
Much more than an index fund.
Oh, absolutely. An index fund spreads the risk out. But a single stock, its price can jump around based on company news, sentiment towards its industry, or just broader economic factors. The guide notes this can be especially true in fast-moving sectors like tech or finance in India.
Okay, let's lay it out clearly then. Pros and cons. Starting with index funds, what are the main advantages, according to the guide?
Okay, pros for index funds. Number one, the guide really emphasizes diversification. Pooling money across many stocks automatically reduces the impact if one company does poorly.
Mitigates risk.
Precisely. Second, as we've covered, those lower expense ratios, they're just more cost-effective over the long run compared to most active funds. And third, simplicity. They're relatively easy to understand and manage. Good for beginners, but also for experienced investors who want that core market exposure.
All right. And the potential downsides.
Yeah.
What are the cons of index funds?
Well, it's interesting. The main potential drawback is you might underperform in a really strong bull market.
How so?
Because an index fund just tracks the average, right? A skilled active manager might be able to pick stocks that do way better than the average in a booming market.
Yeah.
So the index fund won't capture those absolute peak returns.
So you get market returns, not potentially above market returns.
Exactly. The goal is to match the market, not beat it.
Yeah.
But, and this is important, this gives you reliable exposure without the huge risk of trying and maybe failing to pick those winners. You participate in India's overall economic growth.
And the guide also mentioned long-term benefits.
Absolutely. That combination of compounding returns over time, plus the lower fees not eating into those returns. It makes index funds really suitable for long-term goals, like saving for retirement.
Compounding being the key there.
It's incredibly powerful. Your earnings start generating their own earnings. Lower fees mean more of your money stays invested to benefit from that compounding effect. It's a strong wealth-building engine.
Got it. Now, let's flip to individual stocks. What are the big pros highlighted in the guide?
The number one draw, definitely, is the potential for high returns, much higher than you might get from just tracking an index.
If you pick the right stocks.
Right, exactly. If you can identify companies that are undervalued or maybe emerging leaders in growth sectors within India, think tech, pharma, again, the returns could significantly beat the market average.
And dividends, too.
Yes, that's another potential plus. Many established Indian companies pay dividends, offering a regular income stream.
Okay, but we know there are risks. Let's detail the cons of individual stocks more.
Right. The guide is clear. Inherent risks and significant volatility. Stock prices can be hit by economic conditions, company performance, just general investor mood swings.
Lots of factors.
Many factors. And then there's the workload. It demands serious ongoing research and active management, analyzing financials, tracking trends. It takes time and expertise.
You really have to stay on top of it.
You do. You need to monitor your portfolio, decide when to make changes, keep an eye on domestic and global economic news, sector developments.
It's a big commitment.
It is. And finally, success often comes down to market timing, buying low, selling high, which is, let's be honest, incredibly difficult to do consistently. Get the timing wrong, and you can face significant losses.
Okay, so distinct profiles for each. Given that, what does the guide suggest in terms of strategy for investors in India?
Well, the guide really leans towards a balanced approach for many people. It suggests that combining index funds and individual stocks can be quite effective.
Getting the best of both worlds.
Sort of, yeah. You get the stability and diversification from index funds as your base, but you can also allocate a portion to individual stocks for that higher growth potential.
Does it give an example allocation?
It gives an illustrative one, like maybe 70% in index funds for stability, 30% in individual stocks for growth. But it stresses, that's just an example. You have to adjust based on your risk tolerance, your market outlook.
And should that strategy stay fixed or adapt?
Definitely adapt. The guide really hammers this home. The Indian market is dynamic. Economic indicators change, government policies shift, global trends have an impact.
So you need to be flexible.
Absolutely. There might be times when certain individual stocks, maybe in booming sectors, look poised to outperform. Other times, maybe during uncertainty, the safety of broad index funds is more appealing. You need to review and adjust.
And diversification remains key, even within that individual stock portion.
Oh, definitely. The guide reiterates diversification across sectors and industries is crucial for stability and risk reduction, full stop. So even with your individual stock picks, you wouldn't want them all concentrated in, say, just banking or just IT.
So maybe combine broad index funds with specific stocks in maybe emerging areas, like renewables.
That's a good example of a balanced, diversified approach, yes. Covering the broad market and then making targeted bets.
And what about the time frame? How long should people be thinking?
Long term. The guide strongly advises a long-term perspective for both index funds and individual stocks.
Ride out the bumps?
Exactly. Take a long view, let compounding work its magic, and try not to get spooked by short-term market noise or chase quick profits. Patient, consistent investing is the message.
Okay, let's compare them head-to-head now. Risk versus return. How do they stack up directly?
Right. So the guide positions index funds as clearly lower risk.
Yeah.
That's because of the diversification. They spread your money out.
Making them safer, maybe for beginners.
Potentially safer, yes. A more secure entry point, especially if you don't have the time or maybe the confidence yet for deep company analysis.
And individual stocks.
Higher potential returns, definitely. And it's big, but significantly higher volatility. The risk of substantial losses, especially when the market corrects, is real.
What about looking back? Does historical performance in India offer any clues?
It does offer some interesting context. Yeah. The guide notes that historically, quite a few Indian index funds have actually done better than many actively managed funds over the long term.
Really? Better than the professionals trying to beat the market?
Over long periods, yes. That's often been the case, statistically speaking. It highlights how tough active management is and the impact of those higher fees. Individual stocks can deliver spectacular growth, of course, but also much deeper falls. History shows both possibilities.
And how does your investment horizon, how long you plan to invest, affect the choice?
That's a huge factor. If you've got a long time horizon, years or decades, you might be more comfortable riding out the volatility of individual stocks, aiming for that higher long-term growth. But if you need the money sooner, say in a few years,
Then stability matters more.
Exactly. The relative stability of index funds might be a much better fit to protect your capital from short-term dips.
So who is each approach best suited for, according to the guide? Thinking about different types of investors.
A lot comes down to risk tolerance. If you're more risk-averse, you dislike big swings.
Index funds probably feel more comfortable.
Probably, yes. The guide suggests their diversified, less volatile nature aligns better. But if you have a higher tolerance for risk, you're okay with potential ups and downs for a shot at bigger gains.
Then individual stocks might be more appealing.
They might be, yes.
Yeah.
Especially if you enjoy the research aspect.
What about matching the investment to long-term goals?
For big, long-term goals, like retirement or kids' education, the guide kind of leans towards index funds as a core holding. Because of that stability, lower costs, and strong historical long-term performance track record in India relative to many active funds.
And the management style. Passive versus active.
Right. Index funds embody passive management. Set it up, contribute regularly, largely leave alone. Great for hands-off investors. Individual stocks demand active management, constant attention.
And for someone just starting out?
The guide generally points to index funds as a more accessible starting point. It simplifies things. You get market exposure without needing to become an expert stock picker overnight.
Okay, this has been incredibly thorough. As we start to wrap up, what are the absolute key takeaways you want listeners to hold on to from this guide?
I think it boils down to this. Index funds, they offer a passive, diversified, usually lower cost and lower risk way into the market. You get broad exposure.
Right.
Individual stocks. They offer the potential for higher returns, but that comes with much higher volatility, and it demands significant research, analysis, and ongoing active management from you.
So when our listeners are deciding what's right for them, what's the main advice?
It really has to be personal. The guide stresses that. It depends on your investment goals, your comfort level with risk, and frankly, how much you know or want to know about the market.
Conservative versus aggressive.
In simple terms, yes. If you prioritize steady growth and capital preservation, maybe lean towards index funds. If you have a higher risk appetite, maybe a strong understanding of certain sectors, individual stocks could be considered.
But maybe a mix is often best.
The guide strongly suggests that for many investors in India, yes. Combining both strategies, using index funds for the core and individual stocks for potential growth, can be a very sensible way to manage risk and maybe enhance returns.
And any final recommendations from the guide?
Yes. Given how complex and dynamic the Indian market can be, the guide really advises seeking personalized advice. Talk to a qualified financial advisor.
Get professional help.
Yeah, they can help you build a strategy that truly fits your specific needs, your goals, your risk appetite, all within the current market context. That tailored advice can be invaluable.
Okay, so quick recap. Index funds, broad exposure, lower risk, lower fees, more passive. Individual stocks, potential for higher returns, but higher risk, more volatility, requires active effort.
That's a great summary. Captures the essence.
Fantastic. This has been a really insightful deep dive. It definitely clears up a lot about these two major approaches.
Glad to help clarify.
And for you, our listener, as you weigh these options for your own financial journey in the Indian market, here's something to think about. How could a smart combination of passive index investing and active strategic stock picking best serve your unique long-term financial well-being? Thanks for diving deep with us today.